In recent developments, a major update has emerged surrounding the explosive Trump scandal, drawing heightened national interest. Today, we examine the intricate details of potential insider trading and market manipulation linked to a surge in share trading detected mere minutes before President Trump paused 90 tariffs. Political law attorney Joe Birkenstock of San Larif offers a measured and authoritative perspective on these unfolding events. At the center of the controversy is an unusual spike in share activity, coinciding with President Trump's public policy announcement. This situation raises critical questions about the integrity of financial disclosures from federal officials. Under the Stock Act, officially known as the Stock Trading on Congressional Knowledge Act, enacted slightly over a decade ago in response to a similar scandal, federal public officials are obligated to adhere to strict reporting requirements. This legislation supplements earlier disclosure mandates from the 1970s, establishing both a monthly periodic transaction report and an annual comprehensive report. While the annual filings reveal the day on which transactions occurred, they fall short of providing the exact timing, thereby complicating efforts to determine whether trades were executed immediately before or after significant announcements. The investigative process in such cases typically falls under the purview of the Securities and Exchange Commission. When a security trade is executed, trade confirmations issued by brokers contain precise timestamps down to the second. However, these documents do not disclose the motivations behind the trades, leaving investigators with the challenging task of ascertaining whether any insider advantage was exploited. This distinction is particularly significant in instances involving public officials where underlying decisions might be influenced by privileged information. The investigative mechanisms employed by the CC, alongside the roles of the FBI and the Department of Justice, underscore the complexity of proving any illicit intent. Further complicating matters is the division of authority between the executive and legislative branches. For members of Congress and senior staff, enforcement of financial disclosure laws is managed by the respective ethics committees in both the Senate and the House. These committees, structured on a bipartisan basis, have the authority to impose administrative consequences, such as termination of employment, although their findings are not always made public. Past precedents, such as the case involving Matt Gaetz, illustrate that even when internal investigations result in a departure from office, the outcomes are frequently handled with a high degree of confidentiality. An additional layer of legal complexity is introduced by the statute of limitations related to securities violations. There is a 5-year window for the imposition of civil penalties, which, in this particular instance, could extend beyond the current administration, given that the countdown commenced when President Trump rescinded the tariffs. Moreover, in a landmark case pitting Trump against the United States, the Supreme Court affirmed that the president remains immune from prosecution concerning these activities and that his pardon power remains absolute. This immunity means that potential exposure for officials under the executive or legislative branches could be significantly mitigated, providing them with a safeguard against federal actions. Nonetheless, state authorities retain an investigatory role, independent of federal preemption, even though such probes typically remain confidential until criminal charges, if any, are formally brought. In an environment where the public eagerly demands transparency, there remains a persistent tension between the necessity of maintaining confidentiality in ongoing investigations and the imperative for public accountability. Although state-level investigations might unearth evidence of criminal misconduct by lawmakers, any public disclosure would likely be contingent upon an indictment or comparable judicial action. As it stands, should federal enforcement stall or opt not to prosecute, there remains an unresolved question about whether investigative findings might be released to inform the public, thus ensuring that, at the very least, a measure of accountability is met in the public domain. Adding to the complexity, President Trump recently directed the Department of Justice to target specific individuals for further inquiry. This move not only challenges standard investigative protocols, but also calls into question the traditional presumption of regularity that underpins routine law enforcement procedures. As these unprecedented directives unfold, they force legal experts to grapple with new questions about the appropriate balance between executive authority and independent oversight. As this saga evolves, it becomes clear that the intersection of financial disclosure obligations, executive immunity, and investigative rigor presents profound challenges for American governance. The investigation continues to unfold under an atmosphere of intense scrutiny, with legal experts and state authorities poised to play a pivotal role in determining whether these alleged irregularities will ever see full accountability in both federal and state courts.